I got it. All looks like they're starting to come in here.
Yep.
Maybe just give another 10 seconds or so for everyone to join.
All right, let's get this party started. Good morning, everyone, and welcome to AllGen's quarterly update and market review. Today is August 18, 2022, and it's been a year. It's been a summer, and there's a lot of things going on. So we're eager to jump right in and share some of our thoughts, what's going on in the market, also some personal thoughts of what's going on at AllGen. But as always, love to introduce our agenda today. So today we're going to, Jason right after me is going to jump right in with his market review and insights. Then afterwards, I'll give some updates of what's going on in AllGen. And then, as always, we have some Q&A. When we do the Q&A, please remember, and for those who haven't joined us before, number one, this will be recorded. So to all of you attending, you'll have access to this recording afterwards in case you can't stay the whole time or just want to hear or rehear some of the things that you heard today. But it is on listen-only format for attendees. So you can't actually verbally participate, but you can participate in terms of questions. If anything we say today, or even anything we don't say today, if you have questions in general that might seem relevant to what's going on in the economy, in the markets, etc., in your financial plan, we ask that you go ahead and click at your bottom of your screen. There's Q&A button. You can't raise your hand. That's been blocked off, but because there is no interactive participation, but you can hit Q&A and type the questions up. Our goal is to always get to all the questions before the end of the session. So please feel free to type it in anytime. You don't have to wait till the end to type it up, but we will take questions at the end. Okay, so that being said, let's jump right in. Jason, we're gonna do a couple of things first. I love to make sure that people are paying attention. So we're gonna engage our audience a little bit with a couple of questions. So right now it's August. And what's gearing up? It's football season. So I'm going to have a light question and maybe not so light question. So from your perspective, what are you most excited for? NFL, college football, or you couldn't care less? Wow, somebody said college right away. Here we go. Okay, very good. People are answering the questions. All right, so that means the polls are working. People are engaged. People are listening or at least reading. Okay, very good. This is probably one of the highest engagements we've had. Very good. So a little bit decent, evenly distribution. A little bit college football wins out, although you've got about 20% people couldn't care less, and NFL close second to college football. So okay, fun times. Now let's get to a little bit more serious question in terms of economic thoughts. So from your perspective, we've all known that inflation's been a big deal. Okay, so in your world, how is inflation affecting you the most? In what area? Housing, in the area of food, or the area of transportation? So I'll give you guys a second to fill that out. Huh, interesting. Okay. All right, looks like food is winning by a landslide in terms of how inflation is affecting us. And I can see that if you own a home, obviously your mortgage might be fixed there. But at the same time, transportation, we've seen gas prices go up, although they've been starting to come down a little bit, but concerns about oil and things of that nature. So that being the case, let's just jump right in, because I think Jason's going to even start the presentation talking about inflation and share his thoughts on what's going on there. So Jason, take it away.
Yeah, very good. Thank you. So just for recording purposes, today is August 18th, 2022. And just going to jump right in here, kind of leading off on what Paul was talking about with inflation. As we can see in this first chart here, we have two kind of key metrics for inflation. You have the main inflation rate, which right now is at 8.52. And then you have the core inflation rate, which removes the more volatile food and energy at 5.91. So on the brighter side, you can see, if I was to take a magnifying glass, that this has started to go down just a little bit over here. So we don't know if it's quite peaked yet. I can tell you from looking at different commodity prices that definitely a lot of the wheat and soybeans and gas, natural gas and heating oil and you guys have seen, I'm sure, at the gas stations yesterday, I saw $3.49 after, in Florida anyway, my highest I saw was $4.89. However, I did go out to Colorado this summer and it was like $6 or $7. So different states have different prices, but relatively speaking, they have come down. The more volatile food and energy has come down pretty significantly recently. The last question Paul had up there talks about housing as being one of the inflation areas. And if you already own a home, that may not be a big deal. You have a locked-in mortgage. But for those who are renting or those who are trying to buy a home, that is a major deal. And if you look at the CPI, that is 40% of the CPI is your housing. And so if rent and if mortgage prices and if houses in general stay high, that's going to probably keep this inflation number higher, even if some of those other commodities start to come down like food and energy. But let's look at another component of this. Is a little bit of a busy slide here, but I really want to focus more on this blue line. And this blue line here, you can see that, let me get my little pen going here, but you can see this is the wage growth. So when we look at wage growth, what we're looking at is how much your wages are growing year over year. And on average, as you can see up here up top, you have about a 4% annualized wage growth. However, over the last kind of 20 years, what we're looking at is probably closer to more to like a 3% growth rate. When inflation was very high back in the 70s, as you can see by this section right here, looking at the blue line, wage growth was 6, 7, even almost 9% at one point. And you can see here more recently that we got back above 6% in wage growth. So one of the main kind of sticky factors, if you will, for inflation is wage growth. And so this is a key thing that we watch if we're going to look to see if inflation continues to stay high. And what the reason for that is, if people make more money, they're willing to spend more. And it kind of is a chain reaction, because as inflation gets higher, housing costs get higher, gas and food and all that stuff gets higher, then you need more money to be able to live the same standard of living. So, people start demanding more pay at their jobs, and it kind of keeps going back and forth. As you make more, you spend more. And then as you spend more, it causes inflation to go higher, which then causes you to need more money. And so that's kind of a cycle that's very difficult to get out of. So hopefully you just see kind of a quick spike and then come back down here in wage growth, which would then hopefully lead to a lower inflation rate going forward. However, I think that's something we got to watch very closely. And I think odds are this could cause inflation to stay around and stay a little bit higher, maybe not as high as it is right now, but a little bit higher than what we've been used to over the last 20 years for some time. So, and you can see that the other kind of factor here of not just, people demanding more wages because inflation being high, but the other factor that causes a really tight labor market is that unemployment is so low. I don't have a chart for this, but there's almost 2 times as many job openings as there are people searching for jobs. So however, that has started to improve a little bit from the standpoint of a lower ratio, less job openings for people looking for jobs. It's still high though, and it's still definitely, it's closer to like 1.8 instead of where it got this peak of around 2. So as you have that really tight labor market, that also causes people or companies to have a harder time finding employment, so they have to raise their wages as well. So this is something that we want to keep a really close eye on to see if inflation continues to last. So what does the Fed do? Inflation's a problem, right? And it can cause a lot of issues. And the Federal Reserve has kind of 2 main mandates. One of them being to try to keep inflation between 2 and 4%. And then also to kind of keep an unemployment low as well. So one of the main things that the Federal Reserve will do, in order to try to keep inflation low or to kind of fight inflation is they will raise interest rates. And so kind of looking here from a longer term perspective, you can see back in 2000, after the tech bubble or during the tech bubble, they started raising interest rates, got as high as almost 6.5. And then as the housing bubble started to form, they started raising interest rates going into 04, 05 and peaking around 2006. And then, coming out of a long-term, really low inflationary time, markets started to heat up a little bit in 2017, 2018, they started raising interest rates again. Over here more recently, you can see how quickly they raise interest rates. Right here, you can see it kind of goes straight up instead of this more stair-step approach. It has gone really straight up and has gone up very fast. We're now at the point where we finished raising rates last time, right? About the 2.25 to 2.5 point. These dotted lines are kind of market predictions or different predictions of where the Federal Reserve will end the year at and where it'll end the next couple of years. So it's predicted that they'll end the year at about 3.25 to 3.5. And actually the market expectations and the Federal Open Market Committee are pretty much in line with that prediction. And so that's something, so that being said, you have another 1 to 1.25% hikes in interest rates over the next few months as we enter into the end of the year. But if you look a little bit forward, the market expectations are that they will start to come down next year and then even further the year after. The FOMC believes it's going to go up for one more year, just slightly, and then come down the year after with the long-term rate around 2.5. Now, those are predictions. No one knows if that's actually going to happen. But, I think the consensus is right now they'll continue to raise rates this year pretty sharply, pretty aggressively to slow down inflation. It's already starting to have an effect. And then they're going to lower it next year. So that's going to, that's what the Fed's doing to try to fight inflation. Another thing that they do to try to fight inflation is through quantitative tightening. And so, we're looking here not only at the US, but this a little bit more globally of quantitative easing versus quantitative tightening. So let me explain how this chart works here. So this is looking at the Federal Reserve, the Bank of Japan, European Central Bank, and the Bank of England. So some of the largest central banks around the world. When these lines are going up, that's when they're printing money. So as soon as the pandemic happened, right around 2020 here, the beginning of 2020, you can see that immediately, they started printing money to stimulate the economy because there's government lockdowns, people weren't going to work. It really hurt the economy, so they needed to stimulate. So they printed a lot of money. I mean, incredible amounts of money during that time. The whole world did. But you can see now, as we kind of go into the second half of 2022, it's starting to reverse. In fact, the Federal Reserve is actually doing quantitative tightening, where they're now, instead of printing money, they're basically making it disappear. And so as this line goes down, that has a kind of the opposite of stimulation, a depressing, kind of effect on the market. So when you print money, that's usually good for markets. When you tighten, that's usually more difficult for the markets to grow. And then you can see this is where interest rates. The Federal Reserve is up near to. This is how the number of different hikes. And by the end of this year, we should have close to 14 rate hikes. The Bank of England around 11 or 12 hikes, and then European Central Bank will have like 5 or 6 hikes. So the Bank of Japan's keeping them low, but the rest of the world is pretty much raising interest rates. So not only are they doing quantitative tightening, but they're also raising interest rates. So the world is kind of fighting the inflation. And the hope is that obviously they'll slow down inflation, but the potential problem is that they'll and what they really have to do is they have to slow down the economy to slow down inflation. So the risk you take here by tightening so quickly and so aggressively is that you'll slow down the economy, and that'll drive the economy into a recession. And so that's kind of where we're at right now. We're in this middle of trying to fight inflation, but also balance not going too deeply into a recession. So this is a very interesting chart, but a very complicated chart. It kind of puts together what I've been talking about so far in terms of the two ways that the Federal Reserve fights inflation and then the effects that has on the stock market. So the stock market, the S&P 500 is this orange line, and then this blue line is the interest rates, the Federal Reserve funds target rate, and then you have the purple line here. When this is going down, you're doing quantitative tightening. And so the last time this happened was 2018 into 2019. And when they aggressively started raising interest rates and started doing quantitative tightening, the market had a pretty turbulent time. In fact, from this high right here to this low is about a 20% drop. So, but once that got pretty bad, they stopped raising rates. And in fact, they actually started lowering rates. And then obviously, when the pandemic came along, that changed everything, and they really lowered them very sharply, and they started printing money again. But you can see now how much they printed over the last couple of years, and then the correlation with the stock market. When you print money and when you keep interest rates very low, that typically helps out the market. It floods the market with money, and people spend that money. Companies invest that money, buy manufacturing equipment. People consume more, so that's usually good for the economy. But now we're starting to do what we did back here in 2018 again. In fact, we're not starting, we're well into it, where the Federal Reserve has raised interest rates just as much as they did last time when they stopped. And we're just now starting to do the quantitative tightening. In fact, that started in June at about 47.5 billion a month. And now they're going to increase that in September, in a couple weeks, to 95 billion a month. This is important because it's going to take more money out of the economy, and it's going to be more depressing. So, the market does anticipate the future, so it's already kind of anticipating this, and you can see that that's a big reason why the market has dropped so far this year. Now, the big question is what's going to happen with the market going forward. So let's keep going. So if we look here, this is another somewhat complex chart, but a really important one because it's been one of the most accurate factors for recessions historically, and this is called the yield curve. In fact, there's kind of two main yield curves that we watch really closely. This one's the 2-year over the 10-year, and that just means, and just so you understand what a yield curve is, typically in a strong economic time, your short-term interest rates, like 3 months and 2 years, the short-term interest rates are lower than long-term interest rates, like 10-year bonds and 20 and 30-year bonds. That's the normal. That would be a steep yield curve. And then when bad times come along, typically the inverse happens. Short-term interest rates, this one's looking at the 2-year, start to go above the 10-year rates. And when that happens, this line goes below this horizontal line right here, the red line here. So every time that has gone, it has inversed and gone below this line, has led to a recession. And it's like 8 for 8 in the last 60 years in terms of its accuracy. So obviously this happened last time it happened for a very brief period right before the pandemic, without even the pandemic happening. The pandemic actually ended up happening right there, but most likely we were going into a recession even before that. And then definitely in 2006, 2007. And that's the other beautiful thing about this particular indicator. It's a leading indicator. So it gives you the signal sometimes 6 to 12 months before the event actually happens. So that it happened again in 2000, and there's a recession in 91. It kind of gave us the indication in 1990. So it's a really important one to watch. Very similar one, the 3-month and 10-year has also been very accurate and giving very similar signals. It has not gone inverted yet. However, most likely at the next federal interest rate hike, when they raise it by 50 basis points, at least maybe 75 basis points, that should throw that negative, unless something drastic happens in the next month or so. So all that to say is there's a lot of signs pointing to a recession coming, with the Federal Reserve raising interest rates, the quantitative tightening, and then this kind of showing this in the yield curve. Now, one thing that is important, and kind of this helps relate it to actual dollars and what's happening in people's pocketbooks, is if it's what's starting to happen is, or let me rewind a little bit. Back when the pandemic started, right around February, March of 2020, the government started not only printing a lot of money, but fiscally they started sending stimulus checks. And so what this chart here is looking at excess savings, excess personal savings. So when you got all the stimulus, the additional unemployment, our actual incomes as a country went up significantly because a lot of people didn't lose their job and they were getting all these stimulus checks. So they got a lot of surplus. This line going up would be surplus savings. But now, as stimulus has slowed down towards the middle of 2021 and going forward, when people are no longer getting those stimulus checks, and then you throw on top of that recession, not recession, but inflation starting to occur where you have, higher prices, that is starting to dip into people's savings. And so I think one thing that's kind of held off, from a really bad recession in a lot of defaults from people not being able to pay their credit card bills, bankruptcies, things like that, is because people have so much surplus from this segment over here that they built up their savings and they paid down some debt. But now, as you have higher inflation without the stimulus, there's a savings drawdown. And so, to the tune of about 330 billion over the last 6 months, and you can kind of see it starting to increase a little bit month over month. So that's something to keep an eye on, and that's how it's kind of affecting the average everyday person. Is that while their savings did increase during the pandemic for the most part, those savings are starting to come down at the point at which they really kind of drain their savings, and some people have already done that. Then they start going into debt, and that's when things can get out of control a little bit for some of the population. And also, quick plug on our financial planning. That's why we always tell people to have a large emergency reserve and no debt, and to budget well so that they can avoid this. But we're looking at averages here across America. So now, when if we kind of take, this is a really cool chart because this basically takes a lot of the things I was just looking at. It's kind of a bear market probability and also kind of macroeconomic indicators. So taking into effect unemployment and inflation and the yield curve and housing starts and like 10 or 15 different economic indicators, and throwing that all together. When this line down here at the bottom, we're looking at the S&P 500 up top here, but when this line here at the bottom gets above this red line, there's a large chance that we go into a bear market. Now, at one point this year, we were already in a bear market. In fact, at the worst point, the S&P was down 24%. But and then in July, you actually had a really strong rebound. I'll show you a chart on that here in a second. But even despite that rebound in the stock market, and despite something starting to slightly improve like inflation, you're still at a very high probability of a bear market from here. And so every time this indicator has got to the point where it's at right now, 6 months later, on average, the median return was negative 11%. And the win rate, which means how many times it was positive, the market was only positive 23% of the time. And then 9 months later, you can see it was only positive 29% of the time. 1 year later, about a third of the time. And these are the median returns in those time frames. So the picture that is painting is that we could have a little bit of a negative stock market potentially, and the probability of that is pretty high over the intermediate future, kind of 6 month to 1 year time frame. And with that being said, what are we doing about that? One thing that we've done is we have reduced stocks in general, but we've started to increase bonds. And bonds, and I'll get more into bonds here in a second, but this is a great chart. It shows the same exact indicator on the bottom, but instead of charting the returns of the S&P 500, it charts the returns of bonds. And this is looking at the kind of 10-year government bond. But so historically, when the same thing has occurred, where you have a lot of this indicator pointing to difficult times in the stock market, 100% of the time, bonds have been up over the next 1 year. Now, the median return of 4% is not stellar by any means, but at the same time, that's better than losing, like the stock market did historically during these times. So one thing that we have done to prepare for a potentially difficult season ahead is we've already started reducing stocks, and we've just recently started increasing bonds. And I'll get a little bit more into that in a second. But technically speaking, if we're looking at the S&P 500, measuring kind of the 500 largest US companies, this is a chart that goes kind of back about 5 years but you can see the recent downtrend that we started after a really, really strong time from the pandemic low up until basically the end of this year. We've now kind of gone into this downtrend. We had a really strong month of July, and even August has been decent, but now we're coming up to some pretty heavy resistance. You have the 200-day moving average, which is this blue line, which can act like resistance. And then you have this trend line drawn from these previous highs. So the market could have a difficult time getting above this point right here. And so it doesn't mean that the market is, definitely going to go down from here. And all of these things that I'm showing you, there is still a significant chance that the market has already started a bull market, and it can continue to go up from here. As your money manager and as professional money managers, what we try to do is look at what is the highest probability, what are the probabilities of certain events happening, and then trying to kind of really come up with an investment mix that is in line with what we think the highest probability event is going to happen, but then also have contingencies in place and different diversification, or be diversified in a way where if we're wrong, which we could be wrong, and the market could continue to go up, that we'll still make some decent money if the market goes up. So these are some things that we're looking at with the stock market and the bond market. One other thing that we're keeping in mind, and this is a chart I bring up occasionally around this time of year, is that, seasonally speaking, we're going into a kind of a difficult 2-month time frame. So this is looking at different 2-month time frames throughout the year. And, we're kind of, right now we're in this August through September time frame, which, sorry about that. And we're, on average, it's actually been up 58% of the time. But if I want to draw this line wrong, you can see this is a negative, and typically the market average is a negative 0.1% return, which is not a huge negative return, but on average, it's down during this time. We're also just about to go into, in a couple of weeks, the weakest time frame. The weakest time frame, 2-month time frame, is from September through October. The market's only been up on average over historically 48% of the time, which is the least of all the times of all the different 2-month environments. And you can see the returns are negative 0.7%. Again, those aren't large negative returns, but these are averages over a long time, 120 years. And so seasonally speaking, we're going into a really weak time. More reason that I think we need to kind of be prepared for maybe a difficult couple of months ahead, especially with you. And you never want to look at just one thing like seasonality. I would never kind of position our clients' accounts just based off of this. It's really when you have a lot of factors kind of accumulating to kind of point to a certain direction. So you have, the inverted yield curve. You have, the Federal Reserve getting very aggressive at stopping inflation, which is destimulative. You have seasonality. You have, technically speaking, we're reaching resistance. You have a lot of things aligning to say stocks may have a difficult time even after a nice bounce recently. And so this should be a time that we should probably, be in a position that is a little bit defensive and tries to protect during difficult times. So what are we doing to be defensive? I mentioned one thing, we're reducing stocks as a whole, and we've already done that, and we may continue to do a little bit more. And we're increasing bonds. That's kind of one large theme of what we're doing. But at the same time, what this chart is showing is that, if we're looking at year-to-date returns of different sizes, large, mid, and small, and different styles of money management, value versus growth, and then blend is kind of in between that. And we've been talking really since the end of last year that growth has gotten really expensive. And from a valuation perspective, this is looking at valuation. So this category right here would be large growth. So large growth, that would be like Amazon and Tesla and Microsoft and Apple and Nvidia, those type of more growth-oriented companies that are growing really fast, even though they're expensive. That area has been doing really well for a long time, but you can see in terms of its PE versus its 20-year average, it's 135% of its 20-year average. So if it was at its 20-year average, it would be 100%. So you can see it's still very overvalued. It used to be higher than that at the beginning of this year. It's come down a little bit, but it's still significantly overvalued from a 20-year average. So what we have done to protect our client accounts is we have shifted some of our monies, and we started doing this last year, from growth to value. And so you can see value, whether it be a large, mid, or small, have all outperformed growth this year. And this has been a way that we've helped protect our client accounts. Now, July, it was the opposite. When we had a reason, and this actually goes through July, but we had the rebound in July, growth rebounded pretty strong, value rebounded, but not as strong. But we think it's going to continue with the theme that's been on this year as we kind of go into the rest of September, October timeframe. Now, so that's pointing out, not only have we reduced stocks, but we've also tried to target the stocks that are already at a discount. And if you look kind of at the value side, they are in terms of their 20-year PE, they're for the most part below their average, meaning they're cheaper, relatively speaking, to where they historically are from a valuation perspective. That doesn't eliminate risk, but it does reduce some of the risk. So that's something that we are, that's the reason why we've kind of shifted more value, because it typically, when these environments are happening and you have better valuations, then this area should perform better going forward. All right. Now, shifting over to bonds, very busy chart, I know, but it does a good job of kind of explaining the severity of the bond drop at the beginning, or really for the first half of the year. And what we're looking at here on the left side of the chart is the Bloomberg US aggregate. So that is kind of the standard benchmark for bonds. It's kind of like the S&P 500 is for US stocks. The Bloomberg US aggregate is for bonds. It's a combination of government bonds, corporate bonds, various different types of bonds, US bonds. And this looks at its returns year over year. The gray number shows what the returns are through the end of the year, or for this year through current. But then you can see the dot here on the bottom is its lowest point throughout the year. And you can see that this year, and this chart only goes back to 1976, but this year had the worst drop. It was down 13%. And last time we did our market update, in fact, by the end of this last quarter, through the first half of the year, we were basically there. And we were, the bond market was at that point. Since that point, bonds have rebounded a bit and gone up 4% from their lowest point. But I point out that to say, it was a really difficult time. But if we look at the worst times where we ended the year negative, so this year right here was down 3%, the next year was up 19. This year ended the year down 1%, the next year it was up 12. This year was down 2, next year was up 6. Now, this is the first time in a long time where you've had 2 negative years for bonds. And if the chart here on the right looks at a different bond index, this is just looking at 10-year government bonds, which is really more volatile based off of interest rates. But this goes back to 1928, and it's something I've showed in the past. It's really important because if you take the 10 or the largest drops, which was 1969, 1987, and then looked at and so on, all the red negative numbers here, and then looked at the next year, the subsequent year, and you can see the returns up 16, up 8, up 23, up 16, large returns after that. So my point is this: we've gone through a very difficult time in bonds. We were underweight bonds going into this year, but now we think it's an opportunity to move into bonds for a number of reasons. And one, we think the valuation is better. But two, historically, anytime you had these big drops, you've almost always had a really strong rebound. So that's kind of further backs our reasoning for starting to add a little bit to bonds as we continue to reduce stocks, both to try to protect the accounts, but also to try to grow on that side. And I know a lot of conservative accounts have really suffered because of this, because we've had one of the worst bond markets of all time. But now they're starting to recover, and it's getting a little bit better. So last slide I'll point out here, and it's something where we see as an opportunity. This is a slide that we've pointed out a few times over the last year or so. But from a valuation perspective, we've shown that certain pockets of the U.S. stock market, especially large cap growth, are overvalued. And I didn't show the chart, but there are other metrics of the U.S. stock market in general that show historically we're still overvalued. But if you compare the U.S. valuations versus international valuations, we're at one of the lowest discounts of all time. and definitely over the last 30 years or so. And so this is comparing where U.S. valuations are versus international valuations. And international valuations right now are at a 33% discount, meaning they're significantly cheaper than U.S. stocks. And typically when this has happened, the next 5-10 years, international stocks have significantly outperformed. Another way to look at valuations is look at dividend yield. And when dividend yields are much higher, that shows that it's a good valuation. And we're also at a very high point in dividend yields compared to U.S. stock yields. So all that to point out that in terms of an opportunity, this is another area where we see opportunity. Outside of bonds, we also see opportunities in international, especially emerging market stocks. And as they've gotten cheaper over the last few years, we've added a little bit more at a time. We were very underweight for last 10 years in U.S. and emerging markets, but now we see this as an opportunity over the next 5 to 10 years where this should really outperform U.S. stocks. So those are a few kind of high-level things that we're doing and looking at within the stock market. And now maybe we can move it to you, Paul, and you can get into some AllGen updates.
That sounds great. Thank you, Jason, as always, for your insight there. I'm going to quickly pivot and go into some news about what's going on at AllGen, but please remember, I see some questions have already come in. While I do this, we will get to questions at the end after I'm done talking about some AllGen updates. So please hit that Q&A box and type in whatever questions you have so that we can have some questions to answer for you after I'm done with the AllGen updates. And without further ado, want to start our AllGen news today with welcoming our newest team member. Please meet Alyssa. If you haven't spoken to Alyssa yet, all you have to do is call our number and she'll probably pick up the phone or come by our office and she'll greet you with a pleasant smile that you see there in her picture. So she's currently in college pursuing her AA of Business and Health Administration, has a passion for anything involving planning or giving back to others, and just loves spending time with her family and boyfriend, especially at Universal. It's her happy place. So please feel free to welcome Alyssa if you come across her via telephone, email, or on a visit to AllGen. So welcome, Alyssa. Thanks for joining the team. Next, I want to share an event that we have coming up actually very quickly here next week. It's on a weekend. We'll call AllGen for All Generations. We're having our first what's called All Generosity event. It's a day of serving, with everything going on in the world and people struggling here and there. We want to also understand that it's not just about our personal gain, but also about sharing and giving back to the community. So we're going to have a day of serving in partnership with the Orlando Union Rescue Mission. If you're not sure what they do, please feel free to Google them, but they really are a pillar in this community as far as helping people that are in dire economic need and families. So we're going to have what's called a splash party. We're going to be serving there. They're hosting it on Saturday, August 27th. From 10:30 to 1. So we're doing this in conjunction with them and we're volunteering and we're inviting you and all our clients and our friends and family members to join us because we'll need help with things like greeting and serving food and monitoring one of the we have many activity stations. There'll be, I think, bounce houses or Olympic games or things of that nature. So water stuff to cool us off, hopefully from this heat that we're experiencing. So we welcome people of all ages and families who are ready to serve. Keep in mind that minors should be accompanied by an adult, but other than that, it is a family-friendly and community-friendly event. So please join us. We do ask that if you are going to join us or know someone, please sign up so that we can account for you. There's going to be food and things of that nature, but we want to make sure we can count how many people are joining us. So there's a link, dayofserving2022.eventbrite.com. So if you can remember that, if you forget it, just call us or email us and we'll give that to you. But dayofserving2022@eventbrite.com. Also, another update, if you go to our website, you guys have probably seen, we have these video updates and money minutes, and we also have blogs, things that we talk about, not just about the economy, but general issues at large, such as estate planning and health insurance and things of financial planning related. Okay, so one of the features we were asked to consider is that, we have so much material, it's hard to scroll down through everything. So now we added a search button. So if you're going through something saying, hey, should I pay off my car? Should I buy a new car? How much house should I afford? Things of that nature. We might have something that we talked about other than obviously you can always call us and we can take a look at your financial planning situation, but you can also go to our website into the blog section and do a search button. And if there's anything on there, you'll see that it'll take you to that relevant article. So please feel free to capitalize on that. But of course, we always welcome a direct contact. And lastly, I want to mention that we're in August right now. If you did file an extension, this is a friendly reminder on your taxes. The due dates are coming up. So for business owners, corporate taxes are due just under a month now, September 15th. Individuals who filed extensions, your individual tax returns are due October 17th. So that's coming up. If you're a business owner, you might still have a little bit a leeway to reduce some of your taxes, or if you owe some taxes via a corporate plan, feel free to call us to see if it makes sense for you and things of that nature. So that being the case, again, I want to invite you to ask any questions. If you hit that Q&A button, you can type up questions as we go, and we'll try to get to all of them again in the next few minutes here. We're doing well on time today. So I'm going to jump right in, and we had Scott ask a question. It says, how can I help offset the effects of higher inflation on my retirement portfolio? So Jason, going back to the inflation question.
Yeah, absolutely. So, historically, stocks in general actually do well during inflation. So, owning different assets that would tend to appreciate during inflation typically helps offset inflation to a certain degree. And so, and then, with our portfolio, whether it be a retirement portfolio or just any of our portfolios in general, that's what we're trying to do. We see inflation high right now. There's things that we've put in place, over the last couple of years. We've owned and we still own a basket, most of our client accounts, a basket of commodities, basically a commodity fund that invests in different commodities that tend to go up with inflation. So that may be like, any of the energy commodities, oil and gas, and then the foods like wheat and soybeans and, corn, that type of stuff, and then metals, especially precious metals. That fund owns some, has owned some precious metals over time to offset inflation. We also will own, different other things, like maybe we own a pure gold fund, which that is in the portfolio right now. So in general, commodities typically do well in inflation. That's one thing that we own. Stocks typically do well in inflation. So that is one way to offset it. Now, I know this particular year, the stocks have not offset it, but if you look over a longer term time period and even go back to when inflation was really bad in the 70s, for the most part, stocks did well. They did have some big drops in between during really bad recessions, but in the inflationary part of it, they did well. But we also have to balance that of not being too overly, kind of positioned for an inflationary environment in case we go into a recession. And that's if that was the case, inflation may come down. So we have to balance that, which I think is where we're kind of the time frame that we're going into right now. We got to balance that with bonds and hold bonds as you go into recession, because typically the bonds will hold up better than stocks. So it's a matter of kind of weighing those different variables and adjusting the portfolio over time based off of kind of which season we're going into. But it's something we've definitely been preparing for a long time and inputting into our client portfolios.
Very good. And actually, I think you actually addressed the next question I saw, which is the first one was about how do we manage inflation. The second was, well, what about a recession? How do we manage that? And you kind of said it's a balancing act because those are kind of opposing ends.
Yeah, that's right. I mean, it's tough because you have to kind of sometimes what is hitting the news the most and what is affecting people the most, the market has already factored that in. And so I think that's a lot of the case for inflation. In fact, if I brought up some charts of, the crude oil and a lot of these commodities, wheat, soybeans, all these things, they've actually come down a lot. Some of them are down 15, 20, 30%. So if we were just positioned for inflation with a lot of those commodities, that portfolio or that portion of the portfolio would have got hit really hard. But that also tends to happen when you go into a recession. But what does well in a recession is bonds. And so even though we've had one of the worst bond markets ever, actually over the last couple of months, bonds have done really well. And so, it's a balancing act between trying to position for a growth environment, inflationary environment, or a slowdown or a deflationary environment. And we're trying to always adjust those levers accordingly.
Very good, very good. Jason, another question I see here is you haven't mentioned anything about real estate. What are your thoughts about real estate right now?
Yeah, it's a good question. I mentioned the part of where a consumer is on real estate, in terms of how that affects inflation. But from the standpoint of an investment, which I think is more kind of going towards, in fact, right before the call started, the housing numbers came out, and for the third month in a row, it's actually slowed down a little bit. So you're starting to see, like when we peak towards kind of the end of the year, beginning of this year, housing prices were going sky high. One metric that we follow closely is the months of supply. So basically, on how long on average does a home stay on the market before it sells, and what would be typical over time is about 6 months. But we got down to about 1.5 months, which is a crazy hot real estate market towards the end of last year. That's now, as of today, gotten up to 3.3. So still a hot real estate market, but certainly starting to cool down. And some, we're not seeing it as much here in Florida a little bit. But if you look at other areas of the U.S., real estate prices have actually come down. But I think over time, and that's why we're a big advocate of people, at the right point on their path to financial freedom, owning a home. By owning a home, that a home typically over time, returns what inflation would return. So it is kind of an inflation hedge to a certain degree. And, from a pure real estate investment side of things, which would typically be called like a REIT, a real estate investment trust, which we actually have a small portion of those inside of our portfolio. It's about 2 to 3% of our overall portfolios, where basically it's a kind of a portfolio of either apartments or industrial buildings or commercial buildings, or even all the different types of real estate in general, where they basically own the real estate and collect the rents. And so that can also be a pretty good investment in an inflationary time. However, the problem becomes within that context, when you're investing through the stock market into a REIT, is a lot of times those REIT companies are very highly leveraged, which means they have a lot of debt. And so when interest rates start going up, that negatively affects them. So even though the price of the real estate may be going up and the rents are going up, which is good, it's offset by the interest rates going up. And so that's, you have to be careful. We're at kind of the point right now where real estate prices have already gone up significantly. Now interest rates are starting to go up significantly. That should put some downward pressure, and it already has started to put downward pressure on real estate prices. I don't think we're gonna have anything like a 2008 from a real estate perspective, because the big difference between now and then is that you don't have the amount of debt from a consumer level. Banks are a lot more kind of tight and unwilling to lend to those who probably realistically can't afford to buy a home. And so, the big problem in 2008 was people were overly leveraged, and you had people with no doc loans, which means they didn't have to show their income buying homes. So people who really couldn't afford a home were buying them. That's not happening so much this time around. However, prices have gotten really high, affordability has gotten really low. And so you probably will see a slowdown in real estate price increases. And I think pressure on both the prices of the home and pressure on rents, because rents have also gone up significantly over time.
All right, very good. So I think we'll take one more question here. It says, if everything is pointing towards a market downturn, should we not go into cash?
Actually, that's a great question, and I'm glad you brought that up, because I think sometimes when I showed these different indicators and these and it's pointing a picture of a downward market, which I think it is. I think it's better sometimes if we point out a probability of what's likely to occur, and so I think there's about a 60% chance of kind of a extended downward run in the market and stocks going down. And so, but I think there's a 40% chance we've started a new bull market. And so you don't want to put all your eggs in one basket, betting on the market to go down. And all of a sudden, hey, the war in Ukraine ends, inflation comes down, and all of a sudden the market continues to go higher and higher. And you were in cash. That can really hurt a portfolio. That being said, we actually have moved a small portion for a lot of accounts into a high yielding money market fund. And this is strategic in that in case inflation continues to be high and you go to a recession and the Fed has to keep raising rates and bonds don't do as well, then we have that high yielding cash, which is actually yielding over 2.1% right now, the high yielding money market. And so that's there for protection. And in case stocks do take a hit, we can sell some of that money, those money market funds, and buy stocks when they're cheaper. So we'll never go all cash because you never know which direction the market's going to go. But we will increase cash at times, which we have done recently, when we see that there's a good likelihood, again, about a 60% chance that the market will go down. And so we have that, but that other chart I pointed out here kind of that shows, the probability of, so if we go to all cash, we could miss out on something too, because 100% of the time when we reach these conditions, bonds have actually gone up. So, to try to take advantage of that, we'll increase bonds instead of going cash sometimes to offset the market going down. So, then that would typically have a higher return than cash. But we're actually doing both. We're increasing the money markets, and we're increasing bonds, and we're decreasing stocks, and we're targeting the stocks that typically hold up better in recessions. But at the same time, we don't want to put all our eggs in that basket because we could be wrong and the market could continue to go higher. So we do want to have still some irons in the fire that are, I don't like to use the word betting, but that are positioned for a market that can continue to go higher.
Very good, very good. So that wraps up our questions. As you can see, there's a lot of moving parts to this, if you didn't already know that, and that's why we love having Jason and his team watching this for us and sharing with us some thoughts and ideas. As always, we welcome your calls, your emails, or a time to meet with us to talk about what's going on in the market in general, or more specifically, what's going on in your financial life. Here's a plug-in for my department, which is financial planning. In the midst of all this, as history shown that people with a plan can really weather all kinds of economies better than anyone else. I always quote a famous saying that I heard one time is, I can't control the global economy, but I can control mine. So that's what financial planning does. It helps you have a plan to be able to control your economy. So please feel free to reach out to us with any other further questions, or if you want to go deeper into your financial plan and outlook. As always, thank you for attending, and we look forward to seeing you soon. Have a great day.
Thanks, everyone.